Well, welcome back, folks. Happy St. Patty's Day. It's Friday. We got a whole lot to talk about. I'm wearing my nice little Seahawks cap to keep it green. Anyways, guys, we got all sorts of stuff to get into today. This might be a long one, so buckle in. I know I tend to go on and on, but I'm going to try to pack a lot of info into my typical 22-ish minute video. We got a lot going on. So much is going on in the world right now, and we are going to chat about it. Oh, baby, are we going to talk about it? So, a lot of interesting developments today. Whole lots of interesting developments. I really need to pull up the Fed balance sheet because that's the big one I need to talk about. So, banking, not looking good. We are getting some interesting developments here in banking. We are seeing bank stocks getting absolutely hammered today. XLF, the S&P financial sector, down about 3% today. We have that First Republic Bank down 32% today, 33%, and still going down after hours. Mind you, this is after they were given a kind of like angel loan from the rest of the banks trying to restore stability into the banking sector. They were given about $30 billion from the other banks, and it is still plummeting. Banking is not the place to be right now. People are underestimating the pain that is in banking right now. And we really, as the public, don't know exactly how bad it is. But what we do know, we saw this yesterday, huge development. The Fed balance sheet, this has been on the radar for a very long time. We know that this exploded from COVID. We can see this rise on the balance sheet here during COVID. Let's zoom in. So COVID happens, they print trillions. They pump about $3 trillion into the market over the span of about 3 months. Then they steadily keep this going up until March of 2022. Famously, up until March, well after COVID, well after the economy is fully recovered, they were still pumping money into the system. Why is this a big deal? Well, they're printing, and now, oh no, we have inflation. Guess what? Maybe because we printed trillions and trillions over the span of about 30 months. Craziness. So, quantitative tightening, they have been rolling these assets off their balance sheet, trying to get rid of all this crap, trying to suck money back out of the system after they pumped it so full of money. This was going down. About over here, November, we hit about $8.625 trillion on their balance sheet, and now we have shot from $8.3 trillion up to that $8.6 trillion. So that was from November till now, that was about 4.5 months of assets rolling off. They have pumped that back up. They have given a credit line to banks to essentially get loans from the Fed to ensure liquidity in the system, which this is the bailout. This is the bailout. And now you might see people arguing this is not a bailout. Nobody wants to use the word bailout. Nobody wants to mention 2008. If you call something a bailout, it takes people's brains back to 2008, back during the real bailouts. So this is not a technical, like it was a bailout back then where they were literally bailing out entire companies, which included shareholders, it included holders of the corporate bonds, CEOs, all that. They're not doing that. What they are doing is bailing them out in another way. So banks are at a liquidity crunch. They are slowly going insolvent. Well, they're not saying that, but we will see maybe next earnings if that's true or not. So the Fed is they're dropping a discount window. So what happened with Silicon Valley Bank, they have all these bonds. They are stupid. They don't have any risk management. They didn't realize, hey, interest rates go up. All these bonds we bought go down in value. We need to sell these bonds to fill deposits. Boom, bank run happens. They can't sell the bonds. They are selling them at a loss to try to give people their money back. So what do? The Fed buys all their crappy bonds and they say, hey, we'll pay you what you bought these for back 5 years ago. And then in 10 years when they mature, it'll just roll off our balance sheet basically. So if that's not a bailout, let's say I'm a Pokemon collector. I buy a Pikachu card for $2,000 10 years ago or 5 years ago, or maybe even 2 years ago. But then all of a sudden, I bought that card and now I have to pay my bills. I got to pay rent. Oh shoot, I go to sell Pikachu and he's only worth $1,500 and I'm like, son of a bitch, I got $2,000 in loans. I need the full value for this. Or else the tax man's going to come and they're going to start garnishing my wages. I'm going to go belly up. I'm going to go homeless. Well, some sweet gentleman, the Pokemon guru, that Logan Paul guy who apparently scammed Logan Paul, stupid analogy. He comes along and he's like, yeah, I tell you what, I'll give you that $2,000 that you bought that card so you can pay your bills. And then in 10 years from now, I'll set the card on fire. I'll cut it in half. It's gone. But I'm going to give you what you paid for because you really need the help. That is essentially what the Fed is doing for all the banks right now. Which, if that's not a bailout, if I couldn't say that guy giving me $2,000 to pay my bills isn't a bailout, then I don't know what a bailout is. It's absolutely insane these people are trying to not call this a bailout simply because they're so afraid of anyone thinking that this is 2008 again, which we're going to talk in extent about 2008. So the Fed, they are printing again. The printers are back on effectively, and they are eating the losses for these banks right now. Currently, presently, these banks are selling them bonds that have gone down in value, and the Fed is buying these bonds that are now lower in value. They're buying them for the price the banks bought them years ago, so they're completely bailing them out, trying to keep liquidity in the system, which is insane to me that we are at a liquidity crisis after they spent the last 2 years pumping so much liquidity into the system. It's like now there's a liquidity crisis. Where'd the money go? Where did all these trillions go? This is the greed of these banks. This is the greed. The liquidity's gone now. It's like, what the fuck? What are you talking about? We've been pumping it full of liquidity, and now there's a liquidity crisis, and there's still 8 trillion or almost 8.5 trillion of this money still out there. It's absurd. It's completely the definition of kicking the can down the road. It's absolutely disgusting. Everyone, if you're not outraged by the mismanagement from the Fed, you should be. They talk about inflation. They talk about, oh, we got to get inflation down. But shit, we got to print another 300 billion in the span of 6 days. 300 billion in 6 days. That's how numb we are to inflation now. If they did this back in 2008, if we look back at 2008, look at how much money they printed back in 2008. So back in 2008, they went from about under $1 trillion to about $2 trillion. That was a lot of money back then, but now $2 trillion. Oh, that's nothing now. Honestly, it's nothing now. Printing $300 billion over 6 days isn't even shocking now. That is inflation. That is inflation. The fact that we are not like blown away that they just printed $300 billion for these banks over the span of about 6 days. So that's crazy. That's huge news. And that is 100% why tech companies are going crazy right now. The NASDAQ is completely outperforming the S&P 500 recently. Let's look. The NASDAQ on the week, the NASDAQ was up about 6%. Meanwhile, on the week, the S&P 500 was only up about 1.5%. So it is running laps around the S&P 500 right now. Microsoft, I think, had their greenest week since the bottom during COVID. Microsoft just going crazy. Microsoft up 12.5% over the span of this week. Google up about 12.5% as well. Amazon, I want to say, was up about 9%. So tech just going absolutely crazy, 100% because of this. And because now the market is pricing in a Fed rate cut, which we'll talk about that. So let's get into that. Let's get into 2007, 2008, and let's talk all about that. So we are at a crossroads now where is saving the banks, which the banks are clearly, they've done something wrong, where they're already at a liquidity crunch after they've been getting liquidity for the past 2 years, just hand over fist. They've been getting free money. They are addicted to the free money faucet, and they don't know how to function when you stop giving them free money. It's like a heroin addict. You give them methadone or whatever, you know what they get heroin addicts off of, and they're like, damn, this just isn't the same, man. We need that. We got to get that heroin. We need that fix, man. Maybe not a good analogy. I'm sorry if anyone finds that offensive, but anyways, kind of what they're at. I mean, they are so used to the free money faucet, they don't know how to function anymore. So now we're at a crossroads. Do we turn the faucet back on and risk hyperinflation, which we are already kind of at, or do we risk the banking system failing? Which one is the bank system failing would be at the fault of the banks because we don't know how over leveraged they are. Apparently they're really over leveraged because they're taking so much liquidity, they don't have the money. Anyways, so we're at this crossroad. Very interesting. Will the Fed go QE? Will they start printing? Will they start cutting rates? Or do they continue to fight inflation? They can't do both. You can't pump the banks full of money and then try to fight inflation because this money that they're giving the banks now will find its way into the economy. It will trickle into the economy and drown the money supply again. So let's talk about 2008. 2008. I got this nice chart. This is the S&P 500 back here in 2007. So, Bear Stearns bankruptcy. This happened back here July of 2007. We get that Bear Stearns bankruptcy. This is a shocking thing. Bear Stearns, really big bank. Everyone famously talked about, oh, don't sell your Bear Stearns. Jim Cramer was like, yeah, don't sell Bear Stearns. They're good. They're fine. All right, so Fed starts to get dovish here in August of 2007. You can see this candle, this daily candle. We get a nice pump off of this. The S&P starts to pump. We get a big old move from this bottom of this candle. We move up 15% in the S&P 500 from August of 2007 to October of 2007. Then this is what I'm talking about when I say this is only the beginning. This is like a domino effect. It's never just one bank goes bankrupt and the rest are fine. It's a domino effect. So Bear Stearns starts this domino effect, but the Fed, they come in and they say, hey, we're going to save it if things get bad. Things are good. Oh, and also, mind you, what happened to my little note I had? Mind you, right now, it's gone. But right now, back in 2007, the Fed funds rate was at 5.5% essentially over here. Much higher than it is right now, or not much higher, but a little bit higher than it is right now. But also keep in mind, they weren't fighting inflation back then. They just had the Fed funds rate that high just because that's where it should be. This was back before the free money age. This is why 2008 changed everything forever, and we are eating those repercussions now. So things are getting a little worse. We top out. We get a nice bull trap here. We top out from August to October. Everything's looking good. This is where we are right now. This is exactly where we are, where the market, it bottoms, the Fed comes in, they save the day, and we rally. 12% on the S&P 500, big rally. Then we top out over here. This is the top, October of 2007. Things start to get a little worse. So Fed, they come out and they're even more dovish. FOMC meeting here, October 31st of 2007. They cut rates by 25 basis points. Look what the market does. It goes down off of this. We keep tumbling down. The market's like, uh-oh, this can't be good. The market tumbles down about 9% after that. We get another pump up, and the Fed comes back out, and they say, hey, we're going to cut rates another 25%. So we're at 4.75% right now. Not bad. Credit spreads begin to rise here in January of 2008. And now this is very important because credit spreads right now are going crazy. They are shooting up. And credit spreads, when they go up, it is basically that the credit spreads are saying, we think the Fed is going to intervene soon. So this is happening right now. And we see this pullback. We see a big dump. We're dumping 16% from December of 2007 to January. That's a big pullback. That's a big dump. So Fed comes in, another FOMC meeting, next FOMC meeting. They come out and they say, hey, we're going to cut rates by 75 basis points. And sure enough, the market loves that. Damn, the market pumps 10%. So this is how volatile things were back in 2008. Just crazy. The S&P is making these 10% swings like nothing. Oh, there's my little note. Fed funds rate, it's 5.25%, no inflation. So, la-di-da, we chop sideways. Another FOMC meeting. The Fed, they cut rates another 75 basis points. So we have gone from about 5.5 to 3.5% now. Just crazy. And they will continue to unwind interest rates. They'll continue to stimulate. And then we get this is the infamous, notorious 2008 bull trap that we get right here. Very famous. We bounce after they cut rates in March, which is crazy. This happens in March. This is literally right now. We bottom March 17th. It's March 17th today. Who'd have guessed? We bottom here at 12.55, and then we rally 15%. The infamous early year bull trap. We rally from March all the way till halfway through May, and then we top out here at 14.47. Crazy. Meanwhile, the Fed is starting to cut rates even more. Things are beginning to deteriorate. We get A and B financial bankrupt. So we are starting to see the dominoes. This is taking a long time. The first bank filed for bankruptcy all the way back here in July of 2007. This is about a year ago. This is how long of a process this is. So back here, the market was not pricing in how bad this really was. And then over here, it starts to price in. Oh, yeah, this is getting worse. So it's pricing in the recession, Another bank goes bankrupt. End of the 2008 bull trap. We top out up here at this 200-day moving average. Crazy. We hit that perfectly. And then over here, next FOMC meeting in about June, they say, we're going to keep rates at 2%. So they're cutting all the way down to 2%. We bring rates to 2%. And then we get a nice little pullback. We have broken the lows from over here back in March, and then we bounce off of this. Another big old bull trap, another 9% bounce, or about 8% bounce. And then over here, September of 2008, shit hits the fan. We get Lehman Brothers bankrupt. We get Merrill Lynch bankrupt. We get all sorts of bankruptcies. It finally explodes in their face right over here. Explodes, and then we dump. Big dump. So that is the similarities we're seeing today. We have seen, this is the Bear Stearns bankruptcy over here, is right where we're at. This is the Silicon Valley bankruptcy. We have bankrupt bank over here. And then a full year later, this entire process keeps spiraling, domino effect, slowly creeping down. And then we finally hit the climax, and the whole thing goes tits up. And then the Fed comes out, and they start to print money, and it finally starts to crash over here in August 2008. It doesn't bottom all the way until March of 2009. And then that's famously when the Fed, they bail out the banks. So why do I like to talk about this? Well, it's very similar to the situation we're in now. Just nobody wants to say that. But this is unfortunately the closest financial crisis we have to compare to. And it was only 15 years ago, which is the crazy thing. It was only 15 years ago. So, of course, people are going to draw comparisons, but nobody wants to because, oh, God, no one wants to talk about 2008. We can't. No one talk about it. That didn't happen. This isn't 2008. Please, this isn't 2008. No one wants to say it. Which it isn't. Yes, we had the mortgage thing. So that was the big thing back then, was the mortgages. But nobody knew about that back then. Remember The Big Short? No one knew about the mortgage-backed securities, how these synthetic CD credit default swaps that they had, or the synthetic, I can't remember what they call it. Nobody knew about that. No one knew the leverage. So banks are not nearly as leveraged as they were back here, but there could be something out there. There could be something that will begin to lead to defaults on loans. And then when that starts to happen, when people stop paying their bills, so people right now are still paying their bills. But if things get so bad, say unemployment continues to skyrocket or starts to skyrocket, say inflation continues to skyrocket, people aren't getting wage increases. Right now, real wage growth is negative. If you look at I think we're seeing about 4% wage growth with inflation at 6%. That is effectively negative wage growth. How long can this go on until people are unable to pay their pay their bills, pay their loans off, pay their mortgages, pay their car loans, yada, yada, all this stuff. Not to mention federal student loans are supposed to start up sometime this year. Maybe that's the crash. Maybe that's the big, oh shit, this is going to explode in our faces, is the student loans coming back. Who knows? Nobody knows. No one wants to talk about this. No one wants to cause panic. Oh, if you talk about this, you're just fear-mongering. That's what they tell you on CNBC. You're just trying to start fear. It's like, well, is it fear-mongering if there's a real thing to be afraid of? Like, it's just crazy. So this market would have been as easy to play as just doing this. As just going, oh, trend line, break, short. Oh, trend line, break, short. We got another. We're obviously in a downtrend here. Trend, break, short there. I mean, you kind of would have taken some losses on this one. So you get that notorious bull trap. Oh, you short right there. Oh, here we go. We had another bear flag / bull trap. Oh, you short right there at 1292. Continue. Short. As the trend line breaks, easy money. So right now, the big thing that is different from 2008 and that makes, in my opinion, makes it so much worse than 2008 is that we're in where the chart is now. We are doing this. We are, yes, obviously bull trapping. Now the S&P's hitting reality. The difference now is inflation. We have 6% inflation. Back in 2008 or back in 2006, 2007, inflation's sitting right where they wanted it. They wanted it right at 2%. That's where it's sitting, is at 2%. This is a whole new world, baby. We are sitting here with some inflation today, and it is not going anywhere. It is sticky as all hell with a labor market that is tight, and it is not looking good. So that's the big difference. We have to talk about bond volatility. The bond market is going crazy volatility. You don't want to see this. You don't want to see volatility in the bond market. The bond market is supposed to not be volatile. It's not supposed to be volatile. We have the bond market volatility index up here at 180. Last time it was this high, son of a bitch, back in 2009, back in 2008. Ugh. Damn, dude, you don't like seeing that. You don't want to look at the US 2-year chart. Look at what this thing has been doing, man. I mean, look at these daily swings. Down 13%, up 7%, down 8.5%, up 7%, down 8%. This is crazy what is going on in the bond market. This is signaling there is trouble. This is a flight to safety. We are de-risking our portfolios. This is what the banks are doing. They're de-risking portfolios. They're making the bond market go apeshit right now. It's just crazy. Not good. You don't want to see that. So, another thing worth mentioning is the U.S. The yield curve. The yield curve has never failed. Every time it inverts, about a year later, it's always correct in predicting a recession. So, we know the yield curve inverted back over here in August. It has not even been a year from August. It has been about 7 months, and we're already seeing major, major trouble in the system. Bad things happening. Really bad things. And even with the Fed coming in and pumping. Don't take my words lightly. They are pumping the banking sector. We are still tumbling. Still down bigly on XLF. Still down bad on some of these huge banks. Key Bank down 6% today. I mean, we got Wells Fargo down 4%. Wells Fargo going for new lows on this pullback. We got, I think, Charles Schwab. Ooh, that made a nice recovery. Charles Schwab's looking good, man. I don't know why Charles Schwab's again. So we're just seeing all of these banks. No one's avoiding the pain. Bank of America down bad. And we know the unrealized losses a lot of these banks. I mean, Bank of America is sitting on I want to say a couple $100 billion worth of unrealized losses right now in their bond portfolio. I mean, it's shocking. It's crazy. It's wild. It is only just starting. That's what I'm trying to get at. I'm not trying to fearmonger and be like, everyone sell everything. I'm just saying be very, very cautious, especially when you're seeing the NASDAQ do this. I mean, the NASDAQ just going fucking crazy. Look at the volume on the NASDAQ. So this is just classic. Everyone expects things to go down. So what's the market going to do? The exact opposite, especially in tech. This is just absolutely most pain for most people involved, for causing the most pain to the most people. That's what's happening right now. This is just 100% a momentum play, crazy momentum. Tech stocks clearly only care about the Fed funds rate because they are pricing in that they're going to cut. So now I'm asking, what if the Fed comes out on Tuesday or Wednesday, I think is when Powell will actually talk, and they come out and they say, hey, we're not planning on cutting rates anytime soon, bitches. You best get used to this. And what's tech going to do then? Are we just going to go straight back down? I mean, right now the bond market, it's way ahead of itself again. It's done this over and over and over. So right now, yeah, the NASDAQ still looks to the upside. If you just ignored the news, if you had no idea what was going on, you'd be looking at tech right now and being like, damn, it's bottom. We are getting crazy high volume buying in tech right now. Absolutely crazy. Just absolutely nutty buying in tech. So it's, to me, nothing more than just a momentum play. The momentum will fizzle out. I do not believe a bottom has been made. There's just no example of any of this ever happening in history where one bank has gone bankrupt. Or, I mean, like now 4 banks, but the big one, Silicon Valley Bank. There's no example of just one bank going under and then the rest just being fine. And then just everything's good. We've dealt with it. No example of that. So this could be the first time. I'm just saying odds are it's not. Odds are this is only the beginning. It's going to get worse. And the stock market reflects that, especially the financial sector. No one wants a bank stock right now. Everyone's trying to sell. This is institutional selling. This is not just Ma and Pa called up their broker and was like, we don't want our JP Morgan stock anymore. This is big selling. So this cannot be ignored. We haven't seen a yank down like this since, I mean, we got a big yank down over here, I guess, but this is crazy, man. Just crazy. So only the beginning. I would not short banks right now, but I wouldn't go long either. I wouldn't go long on anything right now if I was anyone. If we look at stuff like Nvidia, man. Nvidia. Nvidia just is completely not connected to reality anymore. It is looking like what Tesla was doing back in like 2015 and 16, I think, when Tesla was just literally going straight up, even though everyone, back in like 2019, even though everyone was like, this thing is just stupid. And we know how that ended, even for Tesla. I mean, we saw Tesla crash 60% over here after we ran up basically 300 and some percent. So this is not the first time this has happened. It is just shocking that this is happening to Nvidia right now when the outlook only gets worse and worse by the day. Can you ask yourself, at the beginning of March here over at about $241 a share, do you think the outlook on the economy or on Nvidia in specific got better from the beginning of March, pre all these, when no one knew there was any trouble at all in the banking sector. No one had any idea about this yet. Now we know about this, and Nvidia has gone up 10% on that. I mean, what? Right? What? Right? I mean, is that not the craziest thing you've ever fucking heard? And it is completely just, yeah, of course everyone thought it was going to go down, so naturally it's going to go the opposite and cause pain to everyone involved. But today I'm seeing really high volume selling on Nvidia. Even though we were still green on the day, you can see the volume was insane. Very, very high with an ugly rejection candle. So Nvidia over here finally hitting the supply I've been talking about. I've been talking about this level over here, 260, from about 270 to 260. Expected a rejection. I'm not trying to short this thing. I need to see a crack. This thing is just not cracked. Every pull-up just gets bought, or every pullback just gets bought. It's just crazy. So, anyways, that's. I think I'll cut it off at that. You kind of get the point. No one wants to be doom and gloom, but unfortunately, you don't come to my channel to get lied to. I'm going to give you the cold, hard truth. And now it is not just a bias. It's not just me trying to be bearish. It is just, this is factually the closest thing we've seen to 2008 since 2008. And there's no denying that. All the signs are pointing that this is getting more and more like 2008 by the day. And I'm not saying it's going to be 2008 again. I'm not saying that. I'm just saying it is looking incredibly similar to that. So expect similar results. And with that, I would only ask you, please, to consider subscribing to the channel, hitting the like button on the video, dropping a comment if you disagree, agree with anything I've said. I'm probably going to drop another video on this weekend. Who knows what's going to happen these next couple weeks, man. The Fed meeting is everything. I don't think they're going to say enough to completely change the trajectory of the market right now, but damn, things are just not getting great. And you've seen examples. I've showed you examples. Back in 2008, we got a crazy bull trap. This is not the first time. This is the same market. This isn't the first time. Just because you get bad news doesn't mean things go straight down. The market's going to do what it does. So keep that in mind. Don't get a bias. Just try to stay neutral. Anyways, I'll catch you guys on the next one. Peace.